All right, Quasar Markets Live, Mr. Options himself, Dr. Alan Ellman. Alan, how are you this morning, man?
Doing great. Good to talk with you, Steve.
You've got a good one today. I'm excited about this one. Beware of the shiny objects. There are a lot of shiny objects in the options markets, and sometimes we don't pay attention to exactly what we need to pay attention to. And I think today you're going to tell us what to pay attention to. Is that right?
Yeah, one of the most common mistakes made by covered call writers is going to be the topic for today. And, I thought that would benefit the Quasar universe so that they don't end up making the same mistake that a lot of beginning option traders make. So we're going to talk about my favorite strategy, covered call writing. And I titled it, Beware of the Shiny Object when establishing covered call trades. Once again, this is one of the most common mistakes made by covered call writers because what we should focus on is the percent returns we generate, not the actual dollar amount. And I'm going to be showing you that with a real life example today. So before we get started, Steve, why don't we just review for the Quasar universe what is selling cash secured puts? So if we could move on to the next slide, selling cash secured puts is a low risk option selling strategy. So we are on the sell side of options. And as I told you before, in my presentations, I frame it as if we are the casino, not the player at the slot machine. We start off by getting paid. What are we paid for? We're getting paid to undertake the contractual obligation to sell our shares to the option buyer at a certain price, which is known as the strike price, by a certain date, known as the expiration date. So we know what the shares are worth when we enter the covered call trade, and then we decide what are we willing to sell our shares for and how long should that contract obligation exist. So we set the parameters of the contract and then we get paid. So here's a hypothetical. Stock is trading at $48 a share. Now, for every contract we sell, we must first own 100 shares of that underlying security. So we own 100 shares, let's say. We then sell one $50 call. In this hypothetical, we're going to go with a $50 strike price, higher than current market value. That's called out of the money. You see OTM on the screenshot there, out of the money strike. And let's say we get a premium of $1.50 per share or $150 for the one contract. So for every one contract we sell, we're bringing in $150 in cash, right? But now we have the contractual obligation to sell our shares for $50, and let's say it's a 1 month expiration. So actually the option buyer is controlling our shares for that month. Now, if the price of the stock remains below the $50 agreed upon sales price, well, the option buyer isn't going to say, I got a great idea. Let me exercise that option and buy Allen shares for 50, even though they're trading at market at 48 or 46 or 49.99. It's not going to happen. So what happens in that case? The option expires worthless. We keep the 150 per contract. Now we still own the shares and we're free to sell another option in the next contract cycle. What's the return? 150 on a cost basis of 4,800, 3.1%. Now, what about the other major possible outcome? The price of the stock does in fact supersede the $50 agreed upon sales price on expiration Friday. It moves higher than $50. Now, we could always buy back that option before 4 p.m. Eastern time on expiration Friday, and our shares will not be sold. But let's assume we don't do that and we allow our shares to be sold. Where are we then? Well, we made $150 per share on the option premium, another $2 per share, 48 to 50, on the stock appreciation. If it goes higher than 50, we don't participate in that because we're contractually obligated to sell at 50. Total $350 per share, which represents on a $4,800 cost basis, a 7.3% 1 month return. Now, Steve, I'm not here to tell Quasar members that those are the only two outcomes. you can lose money if the price of the stock moves below the break-even price point of 46.50, 48 minus 150. We could start to lose money, and that's why we also need to be skilled at managing our trades. So there you have a hypothetical on covered call writing, and now let's move on to a common oversight when selling covered calls. Something I did back in the mid 90s when I started teaching myself this strategy as well. And most beginners tend to make this mistake. And I don't want that for Quasar members, and that's why I selected this topic today. So, one of the most common oversights that retail investors, beginning option traders make is they focus in on the dollar amount of the premium rather than the annualized returns. I consider this the shiny object, as you'll see in a minute, because a longer dated option will give you greater premium, but will it give you a greater annualized return? And in this presentation, I'm going to show you why you must focus on annualized returns and not the dollar amount of the premium. We're going to be using NVIDIA, listed on NASDAQ, NVDA, to demonstrate how to avoid these shiny objects. So let's move on now, Steve, to the next slide, and we'll talk about NVIDIA on June 4th, 25 of this year, was trading at 141.39. Now, the 6/6/2025, so that's 3 days away, the 144 strike had a bid price of 72 cents or $72 per contract. Bid price meaning on an option chain or option price list, that's the price. The published bid price is what you would get unless you manage to negotiate a higher price. We're going to use published bid in this presentation. Now, let's go out a month instead of 3 days to the 7/3/2025. Same strike, 144. Now, that had a bid price of $4.70. So now, instead of getting $72 a contract, you're getting $470 a contract. Once again, be careful of the shiny object. Now, Steve, let's go out more than a year. June 18th, 2026. The others were 2025. Same strike, 144. Now we have a bid price of $27.20. That means for every contract we sell, we're going to generate $2,720 into our cash account for every contract. Well, a lot of retail investors will take a look and go, wow, I'm in. I'm $2,720. I want to get my hands on that cash. But should we? That is the question. So let's now move on. We actually took screenshots of the 3 option chains that I'm alluding to here. If we can go to the next slide, Steve. And here we have the 3 option chains. So let's start on the top and work our way down. Now for the June 6th expiration, that's the 3-day trade. We're going to look at the 144 strike, and you could see highlighted in the brown cell in the top third of the screenshot, the 72 cents that I alluded to earlier. Okay. Now, if we go down to the middle section of the screenshot, and that would be the July 3rd, month out, 2025 expiration, and the 144 strike had the premium of $4.70 per share. And finally, if you look all the way down to the bottom third of the screenshot, now we're going to go out more than a year. And that same 144 strike had a bid price of $27.20. So that's it. Now, those are the numbers. Those are the dollar premiums. But what are the annualized returns? And that is what's going to separate these and hopefully show the members of the Quasar community why we must not focus on the shiny object and look to what's really important, and that's the annualized returns. So we took all this information from the option chains that you see here, and in the next slide, we're going to feed that in to the trade management calculator. Now, on the trade management calculator, in the top section, we enter the date that we're entering the trades, and you could see the expiration dates of the trades are circled in the red circle on the top. You could see 6.6, 7.3, both those are 25, and all the way out to the 6.18, 26. So those are entered. The trade entry date on the left shows June 4th. They're all entered on the same date. And you could see in the second column from the top right, we enter the premiums of 72 cents, 470, 27.20. Those are the dollar amounts. Now, let's separate the men from the boys here, Steve. Let's look at the bottom section of the trade management calculator, and you could see circled in red on the bottom left are the number of days in the contracts, 3, 30, and 380. Now, if we take a look on the right side, let's go top to bottom, starting with the brown cells. So the brown cells tells us on that 3-day trade, we're going to generate a 3-day return of 0.51%. Doesn't sound that great, right? But it annualizes out to 61.96%. Those are the brown cells, the 3-day trade. Okay, let's now go to the 1 month out, the 30-day trade in the pink cells. Now, the initial return is 3.32% based on a 30-day trade, annualizes out to 40.44%. Only 2/3 that of the 3-day trade. So right here, before we even go to the longer dated trade, you could see that the shorter dated trade has significantly more annualized return than the 30-day trade. But let's go out to the 380-day trade in the blue cells on the bottom right. And here we have an initial return of 19.24%, but based on a 380-day trade, that annualizes out to 18.48%. So that's less than 1/3 that of the 3-day trade and less than 1/2 that of the 30-day trade. So once again, if we take our eyes off that shiny object, the premium, the dollar premium, and focus in on the actual annualized returns, we could see that we benefit from the shorter dated expirations. Now, one more really important thing that I want to share with the Quasar audience, Steve, and that is the column all the way. Let's go back to the last slide for a sec. The column all the way to the right in the purple cells. Now, you could see here upside potential. What that means is the additional amount of cash that we can generate into our account if the price of NVIDIA goes from 141.39 current market value up to that 144 strike. Again, we use the same strike in all 3 expirations. And that represents an additional cash profit of 1.85% if NVIDIA does in fact move past the 144 strike. However, you will take note here that in a 3-day trade, as NVIDIA is going up in value, you can, after 3 days, enter your next short-dated trade and raise that strike. So the amount of additional appreciation on the stock side can be dramatically, exponentially greater than if you're accepting a potential 1.85% 380-day potential share appreciation. So not only are your returns much greater from an annualized perspective using shorter dated options, but also in terms of the amount of appreciation of share value, which constantly can be raised if the price of the stock is going up, which NVIDIA usually does. Of course, it has its whipsaws down, but generally speaking, it's been one of the historic performers in the history of the stock market. So that's another thing you could take advantage of with the shorter dated options. So let's summarize now in the next slide, Steve. When we craft our covered call trades, we must concentrate not on premium dollar amount. No, that's the shiny object, but rather on the annualized returns. And you must take those initial percent in the context of what time frame we're looking at. 3 days, 30 days, 380 days. That will make a difference when you annualize your returns. So as an example, a 2% initial return for a 1-month contract obligation, that's not so bad, right? That's 24% annualized. But If you're getting 2% on a 6-month obligation, well, like it says here, that may not cut it for most retail investors. So, Steve, what I'm telling Quasar community members, watch out for that shiny object. What do you think, Steve?
Yeah, I mean, that is like when you are looking at options in general, and sometimes we always try to pull out those zero DTEs and we think about it from the perspective of how do I maximize my money. Sometimes we're looking at the right thing. Sometimes we're just trying to we need to make cash. That's what the whole thing's about, right? It's what you do very, very well. And sometimes I get lost in the options sometimes, especially as an options trader, as long as I have been. So I really do appreciate keeping my eye out for that non-shiny object thing that makes me money. So yeah.
Yeah, I wanted to bring it to the attention of the Quasar community because that is one of the biggest mistakes that retail investors make when they first start out. And actually, years ago, somebody told me at a live event, they came to me and said, "Hey, Alan, I subscribe to this newsletter and on covered calls. I've been subscribing it to for the last 2 years." And I said, "Well, what does it tell you?" He goes, "Well, it gives me a list of the most premium you can get for a particular stock." So in other words, they're selecting the highest implied volatility securities, which then will give you the highest premium. But what it didn't tell you was that these high implied volatility securities create the greatest risk to the downside. So you have a strategy like covered call right, which is a low risk strategy, and you're converting it into a high risk strategy. So just to take it to the end of the story here, so I said to him, "Well, how you been doing using this newsletter?" And he goes, "I'm getting destroyed. I don't know what I'm doing wrong." And then I explained to him the risk of these high IV securities. So that's
Right.
another mistake that retail investors make, because these high IV securities also have the shiny object, that high premium.
That's right. I appreciate you, Dr. Ellman, and we'll see you right back here next week, my man.
Thank you, Steve. Appreciate it.